Hello and welcome to this month's edition of our market commentary. Today, let me take you through this month's global and domestic market developments. Let's dive into what shaped the investment landscape and how we are positioned ourselves for the months ahead. Globally, July was dominated by trade tensions and monetary policy actions. USA announced a fresh round of tariffs, including 25% on Indian imports to US, while the Federal Reserve held rates steady, resisting pressure from Trump administration. This cautious stance reflects concerns that high tariffs could reignite inflation. As a result, US 10-year yields hovered around 4.3% to 4.4%, keeping the dollar in check but leaving policy risk tied to trade developments. Meanwhile, US Q2 GDP grew 3%, supported by strong consumption and an improving trade balance. Inflation edged up to 2.7%, partially due to tariffs. However, markets still expect a rate cut by autumn. In Europe, the macro picture improved. The Eurozone composite PMI hit a 11-month high of 51, and with inflation easing to 2%, the ECB also kept rates unchanged. Global equity markets responded positively. US equities rose 3% in July, supported by strong tech earnings. European markets also gained. Trade deals between US and its major partners like the US and Japan helped ease fears of trade wars, intensifying further. However, unresolved disputes remain a source of risk. India and Brazil face higher tariffs, 25% and 50% respectively, highlighting persistent trade headwinds. The impact of escalating trade war was also visible on rupee. The Indian rupee depreciated by 2.3% in July 2025, with FII outflows of $2.1 billion. DIIs, however, remain strong buyers, investing $6.3 billion, driven by robust SIP flows. Meanwhile, India's forex reserves of over $695 billion continue to provide a strong cushion. But it's not all gloom and doom on the trade front for India. The India-UK Free Trade Agreement is a strategic win. It is expected to add over $34 billion to bilateral trade, benefiting sectors like textiles, gems, processed foods, and IT services. Tax cuts such as reducing textiles duty from 12% to 0% enhance India's export competitiveness. The FTA also reduces India's reliance on China and sets precedent for future deals with the US and EU. Despite near-term export headwinds from US tariffs, India's diversified export base and proactive trade strategy provide a strong buffer. Back home, India's macro backdrop remained constructive. Above normal monsoons boosted Kharif sowing and rural sentiment. CPI inflation fell sharply to 2.1% in June, its lowest in 6 years. Food prices remain soft, while core inflation is around 4%, underscoring subdued underlying price pressures. For rural households, outright deflation in some food categories is enhancing purchasing power. High-frequency data continue to point to India's resilience. Manufacturing PMI hit a 17-year high of 59.2. GST collections and power demand are steady, and the trade deficit narrowed to $18 billion. Stable oil prices and a relatively stable INR reinforce India's macro stability heading to H2 FY26. RBI is expected to hold rates in August, maintaining a dovish bias. With this supportive monsoon, low inflation, and robust activity, India is well positioned for the second half of FY26, even as global trade tensions linger. After a sharp rebound from March lows, Indian equities consolidated in July. Benchmark indices declined around 3%. IT and real estate lagged due to weak global demand and delayed rate-sensitive recovery. Pharma, on the other hand, gained 3.3% on stable earnings and defensive positioning. Mid and small caps saw steeper corrections but remain significantly up from March troughs. Despite near-term volatility, the broader market remains supported by strong domestic flows. Q1 FY26 earnings were mixed bag. IT, banking and consumer sectors reported muted performance, leading to higher market volatility. However, this softness is expected to be transient, with festive demand on cards and a favorable base likely to be supportive for Q2 rebound. Oil price remained in the $65 to $75 range as demand growth slowed. This is positive for India as it could lead to easing of inflation and support external stability. Gold held steady near $3,300 per ounce, acting as a safe haven amid trade uncertainty. Industrial metals were mixed. Copper saw a sharp correction after tariff clarifications, while aluminum remained firm on strong demand. Our portfolio allocation continues to favor domestically oriented, fundamentally strong businesses with visibility across growth, margins, and policy tailwinds. The emphasis remains on sectors that are likely to benefit from low interest rates, steady rural demand, and infrastructure-led multiplier effects. We remain selectively positive on large private banks, which continue to trade at a discount to their 5-year average valuations, despite stable asset quality and earnings growth. The RBI's 50 basis points repo cut and 100 basis points CRR reduction have eased funding costs and supported system liquidity. This strengthens the outlook for credit growth across retail and MSME segments. At the margin, smaller private banks may also benefit in a high beta market phase, though allocation remains biased towards lenders with strong liability franchises and underwriting discipline. We are also constructive on select PSU banks, which offer valuation comfort, high dividend yields, and improving profitability metrics. NBFCs, particularly in housing and MSME segment, are well positioned to gain from the easing rate cycle as lower cost of funds improve spreads and incremental demand. We favor domestic pharmaceutical companies, given the valuations in US generic pharma companies remain elevated and face continued pressures and tariff uncertainties in the US generics market. Domestic players benefit from expanding healthcare penetration and consistent volume-led growth. During the phase of uncertainty, defensive positioning through healthcare and domestic pharma stocks should provide the much-needed cushion to the portfolio. Softening crude prices and stable currency dynamics have improved the operating outlook for gas distribution companies. We prefer private oil and gas majors that are well diversified and also have the ability to manage the tariff-related and input cost pressures. Private insurers continue to gain market share, driven by rising health awareness and motor coverage demand increasing. Formalization, digital adoption, and regulatory reforms add to the structural tailwinds. We also like real estate, which continues to gain on the sustained demand at the premium end, and also the end buyers benefit from the much needed rate cuts. We are positive on two-wheelers and select passenger vehicle OEMs, where rural uptick, consistent market share gaining trends, and has the ability to benefit from input cost reliefs and demand recovery. Within consumption, we prefer value-focused discretionary segments, including affordable fashion, retail, and select durables over staples or FMCG, which face valuation constraints and slowing volume growth. We remain cautious on IT, exports pharma, and auto exporters, given soft global demand, weak discretionary spends, and limited visibility on large deal flows. INR stability offers some relief, but earnings risk remains skewed to the downside in the near term. Nevertheless, we would like to pick and choose the best bets in these sectors more from bottom-up basis, which can be least hit by the tariff pressures and also can potentially be the winner when the recovery is visible in these sectors. To sum up, while global uncertainties persist, especially around trade and policy, the Indian economy remains structurally resilient. With benign inflation, policy support, and improving domestic demand, we remain constructive on India's outlook. We believe this is a time to stay invested, stay calm, stay cycle aware, and focus on companies aligned with domestic demand and structural tailwinds. Thank you. We'll continue to monitor developments closely and keep you updated. Happy investing.